Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Okay, everybody. The good news for consumers wanting to transition to an electric vehicle, EV prices are falling fast in the United States. The not so great news is the cheapest models remain far more costly than what other countries have to offer, Tim.
So where is America's $25,000 EV and why can't we get there? With more on this story on the Bloomberg Today, back with us is Bloomberg News auto reporter Keith Naughton, who joins us from Detroit. Keith, first up, the good news. EV prices around the world and around the U.S., they're falling, right?
Yeah, and there's no place where they're falling farther than China, where BYD sells an EV for under $10,000. So that competitive threat is really getting the attention of the automakers in America, who are hustling to try and come up with a $25,000 EV. That's the new bogey. Can we come out with a $25,000 EV?
So wait, can they make money on a $25,000 EV?
Well, so a couple of things, Carol. They think they can, and here's why. One is it's going to be a smaller vehicle, so it will require less battery, and the battery is the most expensive component by far of an EV. And because it's priced so low, you would get higher volume. So they think the combination of higher volume and lower battery costs will lead to profitability. In fact, Ford CEO Jim Farley has said the $25,000 EV they're developing that will come in late 2026 needs to be profitable in its first year.
So why can BYD do a $10,000 EV? Other Chinese automakers do a $10,000 EV, but it's such a struggle and such a challenge for U.S. automakers to do it. Is it all just because of labor costs?
No. There's also the government of China that provides absolutely free money to those automakers. So government support, full government support that would not be legal in the United States or other Western countries, is a lot of what gives China the competitive advantage they have. But yeah, they do have the lowest labor costs pretty much in the world. They're lower than the labor costs in Mexico. And that also gives them a big leg up.
Hey, Keith, one thing I do wonder, does it make sense that it's taken longer to get the cheaper EV or the less expensive EV, if you will? Because so many of the automakers came out with, some really interesting models that folks like, but they were super expensive. Is that logical as we kind of transition from, or transition, if you will, to more EVs, that it makes sense that they were more expensive to begin with, and now we can start to think about how we make them less expensive?
Yeah, I think the idea, Carol, was, like with any new technology, You start at the luxury end and then hopefully it trickles down. But I think what the automakers discovered was coming straight out of the gate with $70,000, $80,000, $100,000 EVs really narrowed your market. There's only so many people who can afford those sorts of vehicles. Maybe they should have been more middle market. GM now has an Equinox that is EV that is more middle market, a medium-sized SUV that will come down by the end of this year. Supposedly, they're going to have a base model that, with the government incentive, would put it at $28,000. So, and as we know, Elon is developing a $25,000 EV as well. It will be
or so he says. Or so he says.
Or so he says.
Not giving you a hard time, but it does seem like he says one thing publicly, right? We've all been kind of waiting for this mass market Tesla, and then reporting and so on and so forth says he's saying something else behind closed doors.
Then
what will actually happen is the robo-taxi that he's now talking about, because he really wants everybody to view Tesla as an AI company, not an auto company. It's the same platform. It's the same vehicle as the $25,000 Tesla. So it seems to me they will produce a $25,000 car. Some of them will have steering wheels and some of them won't.
All right. Hold your breath for August 8th is what Elon Musk would say, because that's when the unveil is supposedly happening. Keith, we can't talk to you and not talk about historical parallels when it comes to what's going on with EVs in China, because you've been covering the auto industry for so many years. And I'm wondering, even though we don't see these cheap EVs coming from China into the US and increasingly not looking like Europe either, Is there still any sort of historical parallel we can look at when U.S. automakers have had to react quickly to a foreign automaker, maybe Japan in the 1980s, 1990s?
Yeah, absolutely. This is the 1980s all over again, except on steroids. Because while certainly the government of Japan supported their automakers, nothing like the government of China supports its automakers. So you have this competitive threat coming, and sure, Joe Biden's 100% tariffs on Chinese EVs can keep them out for a while, but ultimately they'll be here, just like the Japanese came and the Koreans came. I mean, before that, the Germans came. Ultimately, they will be in this market, and that's why the American automakers and the European automakers are rushing to catch up. You know, that Jeep now is owned by Stellantis, which is based in Europe. They are going to come with this $25,000 Jeep, Carlos Tavares, their CEO, just said a couple weeks ago. So, you know, everyone is rushing to be prepared for when the Chinese come into the Western markets.
Hey, you know, Keith, for someone who has watched the auto market for a long time and understands it and understands competition, does the U.S. market need to be protected a little bit, especially when it comes to an EV mass market, before opening the floodgates, if you will, to foreign competition? Because sometimes I wonder if competition gets people to move a little quicker in terms of development, or so I'm curious how you see it, understanding development cycles and the markets.
Absolutely. And tariffs, let's be very clear, tariffs are inflationary. Ask any economist. They are inflationary. They don't protect the consumer. They protect the industry while it gets its act together. And that's what's going on here. Detroit made bets on big, expensive EVs. $100,000 Hummer EVs and the F-150 Lightning, when you get it all tricked out, is way up there. So, you know, they made bets on big electric vehicles that require big batteries to power them. And that turns out to be the wrong bet. So they need a little time to scramble, to go back to the drawing board, literally, and go down to the low end of the market and address the primary concern from mainstream buyers. I know we talk a lot about charging infrastructure, and that's a legitimate thing. But price, that's the impediment to EV adoption.
Keith, who's in the U.S. is closest to pulling this off right now? Is it Ford? I know I can't really call Stellantis a U.S. company, but they certainly own some U.S. companies. Is it GM? Is it Stellantis? Who is it?
I think it might be GM. I mean, Ford's $25,000 EV isn't coming until late 2026. GM says they'll have their revived and revised Chevy Bolt out next year. And that already was the cheapest EV on the American market before GM stopped building it in December. But they're coming back with a new and improved one next year. And as I said, they have this Equinox that's out there. So, you know, they may be the first ones to be out there with an EV that starts in the 20s. But everyone is going to catch up real quickly. Tavares wasn't specific when he was talking about the electric Jeep. He just said it will come to the U.S. very soon. So, you know, within the next 2 years, we're going to see a whole bunch of more affordable EVs from the U.S. makers.
Okay, they're not U.S. makers, but I'm wondering where the Korean companies are with all of these, like the Hyundais and the Kias.
Well, Hyundai and Kia have some really nice EVs that have been popular with consumers. And so, you know, they don't qualify, particularly the ones that are made in Korea, for the $7,500 federal tax credit. So Hyundai and Kia, which is the same company, are just biting the bullet and still giving that discount to their buyers and just taking it out of their hide. So, you know, they are being very aggressive and competitive. The Hyundai feels like they can completely reset their brand and become an EV maker in America.
Let's just hope the charging systems are ready for this mass adoption of cheaper EVs. Fingers crossed. I see it at the highway stop centers. There's not a lot of places necessarily to charge up. Keith Naughton, always appreciate it. Bloomberg News auto reporter Keith Naughton joining us from Detroit. All right, we're going to stay with kind of alt energy renewables to one of the richest individuals in the world who's getting supercharged over nuclear energy.
On that, it's one of our most read stories on the Bloomberg terminal about the world's sixth richest person who says he's ready to invest billions in nuclear power.
We are talking about Bill Gates, who made the media rounds this past weekend, talking about his investments in nuclear power and got into the political momentum behind nuclear on CBS Face the Nation this past weekend.
Of all the climate-related work I'm doing, I'd say the one that has the most bipartisan energy behind it is actually this nuclear work. If we unleash the the innovation power of this country, we tend to lead. And I feel great about the support we're getting from the federal government in this nuclear space.
All right, with more on what Bill Gates is up to, the political will behind the nuclear power, and the rebirth of what it seems like nuclear. Return again to Will Wade. He's Bloomberg News Power and Renewables Energy Editor, right back in our studio. So, Will, good to have you back. It feels like this is becoming a weekly thing when it comes to nuclear. Bill Gates investing in next generation nuclear power, a plant project in Wyoming. What do we know about it, and why is it next gen?
Okay, so Bill Gates is invested in this company called TerraPower, and they're developing a new kind of nuclear reactor. So traditional reactors use water. The fission reaction heats up the water makes steam, the steam makes electricity. He uses liquid sodium. So it's not water, it stays liquid at a much higher temperature. So that allows it to use more of the heat from the fission reaction. So it's a more efficient type of reaction. So it sounds really cool. And if it works, it will be cool. But what's different...
Wait, did I hear if it works?
Well, he hasn't built it yet. He hasn't built it yet. No one's built one yet. But the theory is very solid. There's a lot more energy there. It's years away from completion, so there's obviously a lot of risk between, now they just broke ground on it last week. They don't even have permission from the NRC to actually build the reactor part. So yeah, there's a lot that still needs to happen, but it's a new technology. That's why they call it advanced nuclear.
Are any other countries doing this right now?
Oh, there's a lot of companies working.
Countries.
There's a lot of countries working on advanced nuclear designs. There's a lot of companies.
But has anyone pulled it off yet?
Oh, no.
That's what I'm talking about.
No, the thing about nuclear is it goes...
I'm sorry if we're skeptical a little bit.
Oh, don't be. That's okay.
Or should we not be? That it's
you should be.
Okay.
No, you should be. The thing about nuclear is that it just goes really slowly. So you can have me in here every week, but not a lot's going to change between them.
A little preview from Will Wade.
Right. But you remind us that some of it has to go slowly to make sure that it is safe, it is secure.
Yeah, nuclear has some risks. This is real, which is why they are very careful about how they take every step. And all of these things are new designs that have to be perfected. I mean, we were just talking about all the new EVs. They've been around for, a long, long time, and they're just getting perfected.
Why, Will, are people betting on this smaller new type as the way to move forward with nuclear rather than the proven tech that, yes, is expensive, yes, takes years, but we know works?
So the model that people want to get to is, they call it an SMR, a small modular reactor, where you can build the pieces in a central factory, and they're small enough that you can put them in a shipping container and deliver them on site and just bolt them together. So once we get the technology perfected, which maybe is a mid-2030s type of thing, but if that happens, you just have them turning off the assembly line and being delivered.
Tim's shaking his head. I mean, the timeline and all of this, I understand we have to be safe and careful and secure, but it's kind of mind-blowing when we think about, we're watching climate, we're talking about a killer heat wave, which we're going to talk about later this hour here in New York, but across for 60 million Americans this week, and we just see the effects of climate change rapidly changing our environment.
And Will, you got to forgive me being so skeptical when it comes to timelines here. You're just back from Georgia and Vogtle 4.
Sure.
And, remind us about the timeline there for something that had proven technology.
Yes, the Vogtle 3 and 4 project. It was just completed, and the fourth one went online just a couple months ago. It was 7 years behind schedule. It was 150% over budget. I just did the math earlier. It came in about $35 billion something to build these two big reactors.
Right.
It was a painful process, but people are happy that they've got it done. They're happy they got it across the finish line. Whether it is something that is a motivator to get people to do another one, or if it's going to scare people away, is still the question.
What do you see? I thought it was interesting, Bill Gates saying that the country, I feel great about the support we're getting from the federal government in this nuclear space. What have we seen in terms of the political opinion, if you will, on this? I mean, people's opinion is certainly one thing, but what we are seeing in terms of politics and where politicians and also the federal government, how they are weighing in.
Oh, I literally 20 minutes ago, I was watching Jennifer Granholm, the Energy Secretary, do a presentation out in Vegas at the big conference. She was talking up all of the things that the Biden administration has done. They are very supportive of the nuclear industry. They've got the production tax credit that came in as part of the Inflation Reduction Act. They've got the loan programs offices trying to throw billions and billions of dollars at companies to try and develop nuclear power. I've talked to Jigar Shah, the guy in charge of the LPO office. He's like literally begging people to submit applications so he can throw money at them.
Will, remind us in terms of the overall power that's used by the U.S. when we are on this path to net zero, what portion of that will be powered by nuclear energy?
Well, hopefully a lot more. Right now it's 19%. That's of the U.S. energy mix.
Which surprises me because I thought it just had gone away, but that's just my
No, actually, if you look at the charts of where nuclear fit, it's been rock steady. It has hardly changed. But their goal is to triple it by 2050, which is just a lot. It's an enormous amount.
And we're also using more energy too. So that's the thing. We
are going to start using a lot more energy. Like energy demand in the U.S. has been more or less flat for the last 20 years, but we're seeing projections for it to go way up in the next couple of years.
Biden administration, Bill Gates says he's ready to invest billions more, so he's ready certainly to do his part. Great stuff. Thank you. Appreciate being able to check in once again with Will Wade. He's Bloomberg News Power and Renewable Energy Editor.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Sometimes technology, innovation, and disruption actually involves a company doing just that to itself. Enter Google, home to two elite AI teams, Google Brain and DeepMind, and disrupting that, Tim, by combining it into one AI super unit that it calls Google DeepMind.
Let's get to this Bloomberg Businessweek story. You can read it on the Bloomberg and at bloomberg.com/businessweek. With us in the Bloomberg studio is Businessweek technology editor Joshua Brustein, who joins us in New York. So Joshua, remind us what these two labs were doing separately and why Alphabet, the parent company of Google, decided to bring them together.
Yeah, so Google has for about a decade been pursuing AI in various ways, and it has a history of kind of doing things very far away from trying to make a product out of it, and also actually has a history of having two competing departments trying to do the same thing. So they had a homegrown unit called Google Brain, which came out of Google X, which is its moonshot lab. And they spun that out of X and started working on some AI products that we're making into, that were actually ending up in some of the commercial products. And then I believe in 2014, it acquired a UK-based AI shop called DeepMind, which was working on using AI to beat video games. And this was seen as sort of the foundation for much more ambitious AI projects.
Maybe years ago, people would have heard of DeepMind because it was able to beat a human at Go.
Yeah.
Which I think a lot of people, when that happened, they were like, what's Go?
Yeah.
Because it's not a very popular game in the U.S.
So
that
many
was certainly
questions.
my reaction to it, but that
But
was
also
when it
a
first
really
got-
seminal moment in
Exactly.
AI development. Like this was seen as like groundbreaking and sort of scary for a lot of people at the time. Like if AI can do this, what's next?
Well, speaking of seminal moments or important moments, OpenAI's own work, a paper that they were talking about GPT-3, that was back in 2020, a bit of a wake-up call for Alphabet and Google in terms of their own work on AI?
Yeah, absolutely. So what happened was Google had built some of the foundational technologies that went into GPT-3. They built a type of technology called a transformer, which we don't have to go into, but it is the basis of a lot
so many questions always. But go ahead.
But a basis of a lot of the modern large language models. And Google read what OpenAI was doing in 2020 and realized, oh man, we are building the science here, but someone else is building the products. And that is not where we want to be. And so that kind of kicked off a sort of self-examination to figure out, like, why aren't we doing the things that are actually going to make AI work with consumers out in the world?
So bring us up to speed on where we are today, because I think a lot of people probably saw a few weeks ago when those viral Google search results went around that suggested that people were okay if they were to eat rocks, for example.
Yeah,
because doctors said that was fine.
Exactly.
Explain what happened here.
So about a year ago, Google ended up combining those two labs that we mentioned in an attempt to have a more OpenAI-like process to get stuff out, to really start putting things in front of Google customers. The event you're referring to was from a particular product that would sort of summarize search results in using large language models.
Which everybody who's Googled recently has seen this.
Yeah, absolutely. This was like...
It's the first thing that shows up on the page when you search for something, and it says this is a lab result, it's experimental, but nonetheless, oftentimes it's right.
Yeah, absolutely. They wanted to have some of this. It started showing up. A lot of people think that chatbots will eventually replace the way that we do Google search, and Google's very worried about that, obviously, because that's where a lot of their revenue comes from. But like all large language model based products, the Google product had a tendency to hallucinate, which basically just means make stuff up. They started summarizing the web by taking things that were in fact on the internet but were not great ideas. I believe one of them was to eat rocks. Another one was to put glue on your pizza.
Okay.
To be fair, sometimes they were using The Onion as the source for this stuff. So.
Do not put glue on your pizza. Do not eat rocks.
But what if the
Although I do have a dog that
But what
eats
if the
rocks.
cheese is falling off, Carol?
Do not put glue on your pizza, okay?
Noted.
Just, use your brain here, everybody. Combining the labs, though, what does Google Alphabet, I never know which one to choose, but what do they gain by doing that? What might they lose? Because sometimes folks say internally they like to have different units because they kind of compete against each other and everybody gains or everybody's smarter because of it. So what do they gain by doing this? What might they lose?
Yeah, so the thing they were hoping to gain was to put everyone who was working on advanced AI within Google and get them pulling in the same direction. And that direction was to not only be pursuing AI projects that might be interesting, but to actually have AI projects that would be products sooner than later.
Yeah.
So that's what they would gain. And they have been releasing products. There have been some hiccups, as we've talked about. That is par for the course in AI, frankly. The thing that they could lose is that Google really has done a lot of the foundational research with AI, and they did that by giving researchers a lot of freedom to kind of pursue what they wanted. They worked on small projects. They weren't given commands from on high, and you get surprising work that way.
Right, and think about
exactly.
really like that free time, right, to kind of figure out what could we maybe do.
Exactly, like the classic Google 20% time is that's always been part of Google's culture to kind of experiment and do things that we trust will pay off eventually.
Search and advertising. Fundamental to Google's business. I mean, make no mistake, this is an advertising company that makes its money from advertising. But if we think beyond what Alphabet is trying to do when it comes to AI, what are the quote unquote moonshots, for lack of a better term? Like, yes, we understand that it wants to protect its search business, Joshua, but what else does it want to do beyond that?
In AI, you mean?
Yeah.
I think at this point, there's a little bit of lack of clarity throughout the industry of exactly what the AI business is. It's been coming up on 2 years since the release of ChatGPT. We've spent a lot of time talking about chatbots. They are out there in the world. They are being used in various ways, maybe to replace Google search. I think that Google also has some other products and projects that we think about as AI that are not kind of in the discussion about, like ChatGPT. I mean, Waymo, for instance, an enormous AI project. Yeah. Those things are driving around the streets of San Francisco. The DeepMind lab is working on AlphaFold, which does a lot of work that could be really important healthcare work. But right now, looking for the Google search-sized AI business has not emerged yet. It's not clear. This is where we're going, and we just need to get there.
You talk about that, ultimately Alphabet wants products that are going to pay off for the company, right? That makes sense. They want all of this work to kind of have a payoff, whether it's in, like I said, offerings. Having said that, when they were allowing the two labs, right, they were kind of, offering up certain, computing power. AI takes a lot of computing power, right? And so they kind of had to allocate it too among labs and researchers, right? So there was a little bit, it sounds like almost of competition internally. I wonder if that was how that played into it, just the practicality of, hey guys, this is a lot of computing power. So where do we kind of focus our efforts to, get that payoff?
Yeah, that's a good point. I think that this is actually part of getting Google to all pull in the same way.
It's like kind of a grown-up Google a little bit.
Yeah, like you had, not only do you have researchers, like 3 researchers doing this, 8 researchers doing this, you have all of this computing power, and to build a model along the scale of a GPT-4 or Gemini, that's Google's model, you need to be using most of your computing power, or at least a whole lot of it, on one thing. And that means having a top-down structure where you say, this is the one thing we want to do. And that's really new compared to how Google had been doing things up until a year ago.
So combining these two labs, Joshua, I know that Mark Bergen and Julia Love, who wrote the story, you edited it, spoke to a lot of folks out there about whether or not it has been successful thus far. What's your read on it?
I think that Google is one of the leading AI companies. They are clearly doing things that keep them in the running. And there are things that the market's very unsettled, the tech is very unsettled. I think an interesting thing actually that's come up with the last year under this is up until around that time, people inside Google were unsatisfied because it wasn't commercializing things quickly enough. There were a lot of researchers who left, even ones who did some of the core technology for Google, saying, I want to go to a startup where we actually get a shipped product. Now Google's shipping product, and there are people inside Google saying, why are we doing this? It was more fun when we could just work on whatever we wanted. So there is a tension here within Google about like, what is it you want to do? And you're always going to think, well, the grass is greener.
Interesting, right? Like, yeah, the payoff. I was curious about kind of what the mood was internally. So it sounds like it's a little bit of a mixed bag.
Yeah, it seems like it.
All right, great stuff as always. And this story by our Bloomberg Businessweek team. Joshua, thank you so much.
Great,
really appreciate it. Joshua Brustein, he's technology editor at Bloomberg Businessweek. You can find this story on the Bloomberg and also at Bloomberg.com.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Now to sort of the economic outlook after a big week last week where we heard from the Fed. We also have this week, Carol, a half dozen Fed speakers between tomorrow and Friday. We got retail sales, industrial production. Let's bring in Francis Donald, Global Chief Economist at Manulife Investment Management, joining us this afternoon from Montreal. I mentioned some of the stuff going on this week. The big news next week is PCE. But before we get there, just give us an idea for how you're looking at the economic environment right now post-Fed.
We are looking at it very closely. We're actually in the middle of our quarterly forecast revisions. And when we look at the Fed's forecast, it's almost like they didn't see how much better that inflation print was on Wednesday. And it's almost as if the Fed's outlook feels stale. Thursday, we got another indication that inflation is progressing, to use the Fed's language. And then on Friday, we had import prices, which demonstrated again that there's disinflationary pressure in the economy. That's good news. And we expect that combined with, unfortunately, deterioration in unemployment ahead, by September, the Fed will have what it needs to cut.
Is there something smart, though, in maybe waiting for PCE and just really kind of getting some more certainty, if you will, Francis, when it comes to the inflation print? I mean, and making sure, the Fed doesn't want to be behind the curve, but it also, we know, doesn't want to do things too early. I know some would say it's already behind the curve, but something to making sure that, okay, CPI, PPI, check, but just to really kind of wait maybe for next week and just, I don't know, the reports that they get before July. I don't know. It's interesting. We had a guest before that Charlie Pellet was talking about that maybe you could go away for the summer. Nothing's going to really come to life for the Fed until September.
Yeah, that's exactly how we're looking at it. We're not talking about, does the Fed have enough to cut in July? We're just talking about, were we really in an inflation scare for the first quarter when those numbers were too hot? Was that a trend that was going to persist through year end? And what we've seen in the last month is some evidence that actually, no, tightening does work. It does help bring down that year over year number. We're not just going to wait for the PCE. We have 3 more inflation prints, 3 more job prints, 3 more retail prints, actually maybe even 4 by September. And that's why just about everyone has agreed the Fed is in a holding period until that September number comes. But here's a little trick, actually. We don't really need to wait for PCE to come through because we can map CPI, PPI, and import prices really closely. That's why PCE numbers are not really market movers, because they don't tend to surprise to the upside or the downside. We have the calculation. We're going to see that PCE continues to decline in the right direction. But you're right. We've just gone through the largest price level shock in most people's lives. The Fed is going to want to be absolutely sure. And I think they're going to have to see some deterioration in the job market. It's just that our forecast includes this deterioration in the job market. That's why we feel comfortable with a base case for September.
Francis, how close to 2% are we going to get on PCE by the end of the year?
Probably not as close as the Fed wants. We're kind of believers that we're not going to get back to 2% for the next several years, that we're going to float between 2 and 2.5% on a structural basis. One of the reasons is that inflation is just not as interest rate sensitive as it has been for many of our careers, certainly for the past several decades. The Fed's going to have to contend with that. We call it a critical concession. Already we're seeing this globally. We've had the Bank of Canada, we've had the ECB, we'll have likely some more central banks this week that will cut with inflation above 2%. That's not atypical. Central banks tend to cut on the way down towards 2, not waiting until they arrive. But it's an indication as well that they don't want to sacrifice jobs, they don't want to create a recession just to reach a 2%, which might not be reachable.
I'm glad you used the R word. I mean, can we assume that we don't hit a recession anytime soon? I mean, it's kind of remarkable where we are and the maneuvering that we've seen by the U.S. Central Bank, that we still have a strong job market, although some might debate that as well. But are you, in your modeling, anticipating a recession anywhere in the next 6 to 12 months?
We do have 2 quarters of negative GDP in our outlook. We didn't impose that. We're not trying to make a big opinion that a recession is coming for the U.S., but we see a slowdown in the consumer driven by, it's simple, Econ 101, higher interest rates. Remember, it takes 2 years for that first rate hike to work its way through the economy completely, and we're just 2 years and a little bit past that first rate hike. So we believe that the impact of rate cuts isn't behind us, it's in front of us. And so recession risk is being underappreciated by markets. At the same time, they're 2 shallow negative GDP prints. If we were disagreeing between 1 and 1.5, no one would really make a fuss of that. It's just that when you talk about 2 negative GDP prints, suddenly it makes it like there's this huge binary outcome, recession versus non-recession. We're just talking about a slowdown in growth, which the Fed wants.
Francis, I can't tell what your dog wants. They want to slow down, or... I'm just kidding.
So exactly. I think he has strong opinions and a really big fan of Bloomberg Radio. Joined us today.
It's okay.
You know what? He can come on, or she can come on anytime.
I mean, Carol,
lovely to hear.
It's bringing back memories of you working from home during the pandemic when
Scout
Scout would join the show a little bit.
Scout was very loud on the show. It's really interesting, Francis. I mean, you know, I keep wondering, there's still a lot of liquidity out there in the market. So I do wonder, are we still kind of working? I mean, I think we are still working, right? That liquidity through the system. And so we're not really still quite sure what the true picture is of our economy post-pandemic. Is that fair?
Oh, it's completely fair. And that's one of the big challenges with forecasting right now is we're still grappling with that pro-cyclical government spending and what's the path for that ahead. We're still grappling with what exactly are consumers going to spend on and pull back in. We know that their consumption basket has changed. We're grappling with, are there excess savings left? We don't really have a good measurement for that. We know that wealthy individuals have more. We know there's less now than a year ago. But the entire profession, I'm actually writing my mid-year outlook right now, is grappling with how forecasting has changed, how what's happened in the past few years to change our biases. For example, should we cut later and allow more disinflation in the economy? There is no such thing as a sure thing. Even as the Fed's Harker today, I saw the quotes across Bloomberg. It could be 1 cut, he said, or it could be 0 or 2. And I thought, well, it's pretty honest and exactly how the rest of us are thinking right now.
Hey, data dependent, Carol. We hear it over and over again. Francis, 30 seconds. Speaking of the data, just give us your view on the job market right now, at least here in the U.S., because we are getting some confusing signs that, yes, things are slowing down, but then we had, the May payrolls report just blow everything out of the water.
The payrolls did, but the household employment, if you ask households, is actually much worse. Consumer confidence is doing really poorly. for me, the big question has been, when is everyone going to stop talking about normalizing and start talking about weakening of the labor market? And I think we're actually on that cusp right now. Just about every labor market indicator is back to just about before COVID, back to what they would call normal levels. But economies don't come halfway down the hill and then stop. They have momentum behind them.
Right.
So right now, in level terms, we're doing just fine. It's not a labor market to be afraid of. But if we continue to see this deterioration in job openings, quit levels, hiring rates, it's going to flow into non-farm payrolls. And we're not going to be talking about normalizing of the job market.
Right.
We're going to be talking about a softening of the job market that's more concerning.
Well, that's why I ask you 10 seconds. You got to be quick. So when we do start to see things turn differently for the job market, is it a slow turn or is it happen rapidly? Very quickly, if you could.
It's never slow, Carol. It's
That's
exponential. We can only hope that it doesn't go to levels as we've seen in the past.
All right. Such good stuff. What's your dog's name?
Louie.
Louie?
Love Louie.
All right. Listen, great to have both of you with us. Francis Donald is Global Chief Economist at Manulife Investment Management, joining us from Montreal.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, Carol, we chatted about it a bit earlier with Will Wade, how Bill Gates has said he's prepared to plow billions of dollars into a next-gen nuclear power plant project in Wyoming. That's to meet growing U.S. electricity needs. Carbon-free nuclear power increasingly seen as a key part of fighting climate change, and more companies are promoting smaller reactors.
Yeah, absolutely. And so it's interesting, and it really got us thinking a little bit more about what we need in terms of the labor market to support it. And so that kind of gets us to our next guest, who says there's a skills gap when it comes to driving the transition to net zero. With us is Sue Duke.
She's Vice President of Global Public Policy and Economic Graph at LinkedIn. She joins us from Dublin, Ireland tonight. LinkedIn's members generate about 5 million updates each second, according to the company, and the Economic Graph draws insights from those updates. Sue, good to have you with us. How are you?
I'm good. It's great to be here. Thank you for having me.
Yeah, thanks for joining us. Hey, we're going to get to green jobs in just a second, but because you're at LinkedIn and you have all this data, we got to ask you about the greater jobs market, especially here in the United States. What does your data tell you about how the job market is here in the U.S. right now?
We have, as you know, over the past couple of years, seen a slowdown in hiring across a lot of sectors. That slowdown was coming off the back of the hiring frenzy that we saw over the course of the pandemic. But over the past couple of months, we have started to see some improvements in that slowdown, particularly in some key sectors like retail and real estate.
Interesting. Okay. Are there certain sectors that you're seeing right now that are particularly strong?
Sectors like that we are seeing some improvement in, and a key area where we're seeing high demand is when it comes to these green skills and these green jobs. There we see hiring in this space outpacing general hiring by up to 44%. So this is an area of real strength across the board in the US.
Well, Sue, you know, it was interesting on our planning call with our producer and team. One of the things, like, we started talking, like, what is a green job? What exactly is a green job? And what are the particular skills that are needed for a green job? Love for you to kind of dig a little bit deeper into that.
Yeah, it's a great question. A green job is a job whose core focus is combating climate change. So think of jobs like energy engineer, solar panel installer, wind turbine technician. And of course, to do one of these green jobs, you need lots of green skills. They're skills that are either preserving natural resources or taking pollution out of the environment. And what's really interesting is that we see these green skills, of course, showing up and powering those green jobs, but they're also showing up in a whole range of traditional jobs like data scientist, fleet manager, healthcare worker, jobs that aren't traditionally thought of as green jobs per se, but jobs that are going green all the time.
You argue that there is a skills gap between what is needed and what's available right now. What do the data tell you about what people don't have in terms of qualifications for these jobs?
That's right. What today's research from LinkedIn shows very clearly is that Gen Z, a generation that's most concerned about climate change, is the generation that's least prepared to fight climate change in their careers. Today, only 1 in 20 Gen Z has a green skill, and that means that they are not set up to take advantage of the opportunities that this transition presents. and go and work in these roles, both those green roles and those roles that are starting to go green all the time.
You know, it's interesting. I always think about go back a few years when a lot of the big tech companies were worried about coders and not having the right job, right workers for what they were going to need. And so they were tapping not just colleges, but high schools to make sure that they had a pipeline of workers for what they needed. Where are we seeing kind of private, public sector, or what kind of collaborations are we seeing within the green industry to make sure that they've got the workers they need?
We're not seeing enough training. We're not seeing enough collaboration. We're not seeing enough of those partnerships. Fully 4 in 5 of these Gen Z workers are telling us, I would love to get a job in this space, but I don't know where to go to get that training and break into those roles. And you're exactly right. It's exactly those kind of partnerships across government and across the private sector that we need to see scaled much more, rolled out at a much faster rate than what we're seeing right now if we're going to get to grips with this skills mismatch that we see across the board.
I'm going back to like what you said earlier about a solar panel installer. And, we have talked here at Bloomberg about people within the construction industry or home market, if you will, whether it's a plumber, electrician, like they're just not enough out there in terms of meeting demand. And I do also wonder that there's kind of a view of a lot of the younger generation are like, I don't want to do that. That's not what I want to do. And I do also wonder in these green jobs, how many maybe are wanting to do something to protect the climate, but they don't necessarily want a lot of these jobs.
What our research is telling us loud and clear is that these young workers, they want these jobs, they want to get into these roles, but currently there is this skills mismatch and there is this awareness mismatch, which means they're struggling to break into them. And their roles right across the board, including the roles that you're talking about there. And one of the key things that we need to focus on is that for some of these roles, for example, to get from being a general installer to a solar panel installer, as you say, often that's a handful of skills, photovoltaics, energy efficiency, and we can get these workers this targeted training and get them into these roles and accessing these opportunities that are out there today and we know are going to grow tomorrow.
To what extent or what portion of these jobs that you define are quote unquote trades versus quote unquote professional jobs? Because we're at a trade skills gap here in the U.S. right now. I mean, we can't find enough plumbers or electricians at this point. So how do we, get enough solar panel installers?
There's no question, but there is a huge demand for those kind of workers right now. There's 2 key areas. When we look at the fastest growing and most in-demand green skills in the US, there's 2 categories that jump out at you very quickly. The first is in that energy space, including in energy infrastructure. So some of the fastest growing in-demand skills are energy efficiency, solar energy, wind power, energy efficiency, huge demand there. And the second category that we see growing all the time, again, showing up in the top 10 most in-demand green skills in the US, skills related to the regulation and oversight of carbon emissions. So energy audits, carbon credits, those kind of skills surging in demand all the time. And as you say, in both areas, we are seeing this mismatch and this lack of talent coming through, despite the fact that we know the appetite is there, we know the commitment and the passion is there from these young people. We need to tap into that and harness that so that we can get to grips with this mismatch.
So I am wondering, I'm thinking about folks who are listening, whether they've got kids that are in college or thinking about like, how should we be guiding kind of the next generation here?
Three things for these young workers to think about as they think about getting these opportunities and open the door to these kind of jobs. The first is think about your next role. What is that first job that you want and how do you use it to activate your role in the green economy? Secondly, skills. What are the specific skills that you need to get into that role? There are a ton of resources out there, including on LinkedIn, that can help you gain those skills. And thirdly, think about your network. There is a big, vibrant, active community out there in LinkedIn that can give you advice, help you figure out what skills you need, and help open up those doors to you as you think about your role in this space.
Hey, just real quickly, 20 seconds. I mean, how many of the jobs that are on LinkedIn, how many of them are actually green jobs that are out there and open?
when we look across the board at the jobs that are out there, beyond green jobs, it's jobs looking for green skills. And that is a very significant and growing demand all the time. For example, in the UK today, every 1 in 3 jobs on our platform is looking for a green skill. And so that really gives you a sense of the scale and extent of the demand that's out there.
All right. That actually is helpful information. All right. Sue Duke, thank you so much. Sue is Vice President of Global Public Policy and Economic Graph at LinkedIn, joining us from Dublin, Ireland.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 18 minutes left in the trading session. Charlie Pellet just breaking down the trade for you. We're pretty much hovering near our best levels of the session. It does look like we're going to get, the 30th record this year on the S&P 500.
But who's counting?
We are.
Yeah, we are.
That's what we do. We love data points. Let's get to it because we are seeing U.S. stock bulls getting even bolder. Goldman boosting its year-end target for the S&P to 5,600. That's nothing compared to Evercore. We talked about this with Abigail, which upped its call to 6,000. Citi, meantime, upgraded U.S. equities to overweight. So, like it's a big poker game. All in on the U.S. That's what it feels like.
Well, let's get into it with Paul Christopher, Head of Global Investment Strategy over at the Wells Fargo Investment Institute. Paul, good to have you with us this afternoon. How are you?
Yeah, good. Happy to be on the drive home.
Depending on where you're going, you could be driving to lunch too if you're out there in California.
That's so true.
Hey, I'm wondering what you're all in on at the Wells Fargo Investment Institute. It certainly seems like investors here in the U.S. or around the world are all in on U.S. equities, but how are you thinking about things?
Yeah, we like U.S. equities better than international. We like U.S. equities, large caps, better than mid caps and small caps. So we'll play along up to that point, but we'll also note things like, last June, we also had a very narrow leadership like we're having this June. The top stocks in the index top 10 up to about 2.5. And, the bottom 350 down about 2.5. So we're going to be a little bit selective here.
So explain that. Carry that one out. What does being selective mean in this environment?
Yeah, I was hoping you'd ask for the follow. So we like things that have sectors that have a good long-term prospects based on what we're seeing in the economy, and that really haven't necessarily participated to the same extent as the Magnificent 7 or 10 or 5 or however many you want to count it on any given day. We like industrials, right? We're seeing lots of build out in factories. We're seeing build out in data centers. We're expecting a lot more building around electric utilities as we get into green energy. We like materials as well. You're going to need materials for all that building. We like healthcare. We think healthcare, really the pandemic exposed what we might call a lack of capacity. We have another pandemic or even a significant health emergency. We're still going to need to be able to treat broken knees and appendix operations. So we like healthcare. And we like energy. We think probably the green energy future is on its way, but not quite here yet. And we're going to need more fossil fuels going forward. So those four really appeal to us, especially from a valuation standpoint. But long-term investors really should pay attention, we think, to the sectors like those. And that's how we're trying to be selective here.
Well, I didn't hear from you anything about about technology and communication services just now.
Yeah, we're neutral those sectors. We like them going forward, but in fact, we were overweight them until last June, and then they really just took off. And we just don't like these valuations here. We tend to follow that old saying on Wall Street that disruptive technology tends to be overestimated in the short run and underestimated and appreciated in the long run. So we've got reports out there. We like artificial intelligence. We just don't think that the companies that are being bought right now are necessarily going to be the winners. One of my favorite questions to ask clients is, do you remember what the maker was of the first PC you ever owned? And I can tell you that the maker of mine no longer exists. And that was just a few decades ago.
I think ours was Gateway. Do you remember yours?
That sounds familiar.
I don't remember what our first one was.
What's interesting, though, is I believe...
I'm trying to think.
I'm trying to think if it was AMD or Pentium, or AMD or Intel, I mean.
I'm sure it was like Intel,
the
right? The
Pentium.
chips.
I'm just trying to think of like the internals. You got me.
But there is
thinking.
But there is something about. Well, so what is that kind of a warning sign to those who are all plowing into NVIDIA?
Well, yes, and maybe there's a certain extent to which even some of these high-flying tech stocks have become defensives. If you think about the upcoming elections, if you think about the economy slowing down, gee, should I buy staples or should I buy discretionary? Oh, to heck with it. I'm just going to buy something reliable and I'm going to go to tech. I think that's the mindset of some investors today also.
Interesting. Okay. I want to think about this from the perspective of the Federal Reserve, because that's something we watch closely here, of course, and I know all certainly investors do. How are you thinking about the rate environment right now? Because there obviously is a big connection between rates and what you're seeing with equities.
Yeah, well, the Fed has sort of on the one hand, on the other hand, the way good economists always do. On the one hand, they've got an economy that's slowing nicely for them. The whole thing isn't falling into a ditch. You've got manufacturing and construction that's strong. Home building is still strong, but you've got maybe mortgage rates that are too high, and the consumer is under a lot of stress. And the longer you keep these rates up here, the longer the consumer stays under stress. So you've got good things going on, you've got bad things going on, and probably from the Fed's perspective, that means that the balance between those two means you can afford to wait a little longer. You don't have to feel like you're going to drive the economy into a ditch and then need 5 or 6 rate cuts in a real big hurry. They're going to be able to take their time here. September is potentially still on the table if we get weaker inflation readings over the rest of the summer. If not, then November and December probably. We think there's a couple of rate cuts coming this year and then potentially more next year. So the problem for the Fed is that the longer they are patient and the longer they leave these rates in place, the more pressure they put on consumers. And that's where it gets a little bit dicey. Does the consumer just sort of slow down and postpone expenditures? We've heard stories about people, for example, maybe they're not buying the summer wear in April. Maybe they're waiting until June or July right before they go on the trip. Maybe they're getting a little bit more selective about where they shop and so forth. So that's the risk for the Fed.
We are seeing it, not even maybe. We definitely are seeing like some choices being made. Paul, having said that, I feel like for a while the narrative was, hey, there's all this money sitting on the sidelines that's in, cash or cash-like investments that's getting, 4 to 5% right now, and wait till that comes into the stock market. Our story by Alexandra Semenova saying some stock market optimists have speculated that swath of the roughly $6 trillion sitting in money market, maybe will not actually come in to the market. So it's kind of interesting. Is your upbeat outlook in terms of the equity play, is it based on more money that's been on the sidelines coming in or no?
We're still seeing more money come in from the sidelines, but we're also watching for the potential for liquidity to really go away. If we got a nice pullback in stocks, that would help do it. The Treasury has a lot to say about that in terms of how they raise money and how they spend money. April was a down month for the Treasury. A lot of tax money, spending, a lot of tax money coming in. So liquidity goes out of the market and the market falters a little bit. In May, the Treasury starts spending again. Liquidity comes right back into the economy and tech stocks are flying high again. So we're watching liquidity here very carefully. And I don't think that $6 trillion, to your point, does find its way into the equity market. We've been watching clients hold lots of cash on the sidelines since 2008, 2009.
All right, going to leave it there. Hey, Paul, thank you so much. Paul Christopher, Head of Global Investment Strategy at Wells Fargo Investment Institute, joining us from St. Louis.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.